The U.S. initial public offering market appears to be entering one of its most consequential periods in years. The potential 2026 class is unusual not only because of the number of companies considering public listings, but because several would be large enough to matter for major equity indexes, passive fund flows, and the broader market narrative around artificial intelligence. The distinction between the offering price and the first public trading price is especially important. The IPO price is the price at which shares are allocated by the underwriting banks, usually largely to institutional investors. Many ordinary investors do not receive meaningful access to that price. They buy after the stock starts trading, sometimes after a first-day pop. A company can be an excellent business and still be a disappointing IPO investment if the first public price already discounts years of optimistic growth. Investors should also understand lockups. In many IPOs, insiders and early private investors agree not to sell for a period, often around 180 days. When that lockup expires, additional supply can enter the market. That supply does not guarantee a decline, but it can create an overhang, especially when early investors have large unrealized gains and public market investors are still debating valuations. The average maximum drawdown in the first year after an IPO was 48.9%, and the median drawdown was similar at 48.0%. That means even most positive outcomes typically experience steep declines in their first year of trading in public markets. Relative performance was also challenging. Only 40.6% of the sample outperformed the S&P 500 during the first year after listing. Valuation discipline is equally important. Price-to-sales multiples can be useful for fast-growing companies, but they are not a substitute for unit economics. A company trading at a high sales multiple must eventually convert revenue into earnings and cash flow. If the stock prices are in near-perfect execution, even strong operating performance may not be enough. Historically, first-year IPO performance has been choppy, the median outcome has been negative in our sample, and drawdowns have been severe. The coming class may end up including one or multiple truly exceptional businesses. That still does not mean every new issue will be a good investment on day one. If you have questions about the stock market or your investments, contact us today at Ox Road Capital.